Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Graham Campbell, manager of the Saracen Global Income and Growth Fund. Hi Graham.
Good morning. So
if we have a look at where you're investing in your Global Income and Growth Fund, it looks as if you're quite heavily invested in developed markets, proportionally in the US, about a third of the portfolio, and indeed about a third to 40% of the portfolio in Europe. But you don't look at it as where stocks are domiciled, do you?
No, we don't. And the businesses we invest in are global leading businesses, and we're relatively indifferent to where they're domiciled. We're interested in businesses that have growth and pay strong dividends, but if they're domiciled in Europe or North America or Japan or anywhere else, it's relatively we're indifferent. It's about the quality of their earnings and where they're actually selling the business.
And you showed me a graph earlier which showed the portfolio by revenues, and that is actually a much more diverse portfolio, including a sizable allocation to emerging markets.
Yes, we find we're interested in businesses that are able to grow sales. And clearly with emerging markets growing faster than parts of Europe, for example, we're interested in businesses that have some exposure to these markets. But we can't always find them that are just local businesses because issues of their accounting policies or shareholding structure, or just because they're very local businesses. We'd rather invest in businesses we have more knowledge and also where we can have more confidence in our forecasting.
Looking then at the sectors which you've been investing in, you've been over the last 18 months moving out of more consumer names that could be called bond proxies, and into these more industrial names, including miners and energy stocks, which have been quite controversial over the last 18 months because, of course, commodities have been extremely volatile. What's given you the confidence to say, actually, we're going to go for it and we're going to invest in those industrial stocks?
The biggest thing is valuation. And when we analyse a business for investment, we try and forecast the next 5 years of cash earnings, balance sheet cash flow. And we have some confidence rather than worrying about this quarter's numbers. If we feel comfortable that the business can survive the downturn, then we feel as if the lowest cost producers can do very well over the longer term. And we found that valuations in many more cyclical sectors have rarely been this cheap.
And do you have to make a base case scenario for those underlying commodity prices, for the underlying price of oil, or is it much more about that individual company and the way they run their business?
There's both things there. I think there are two vital parts to our analysis. Firstly, we make our underlying assumptions about what we think will occur. We also worry about what we call a worst case. Where could we be wrong? So we'll assume that if the oil price, for example, did not recover to $30, $40, for example, over the next 3, 4 or 5 years, what would happen to their balance sheet? Could they pay their dividends? So this worst case is very important when you analyse cyclical businesses. But we felt that businesses like BP, Chevron, Rio Tinto are very strong players with relatively strong balance sheets in their sectors, and they're often the lower cost producers, and they will survive and prosper over the next 3, 4 and 5 years.
Looking then at the stocks that you've been selling off over the last couple of years, these are companies that have done incredibly well, partly because they are income payers, and people have been coming out of bonds because there's just no income to be found in bonds, and moving into these high quality income paying stocks, pushing up the price. We've started to see this reverse over the last 6 weeks, but we're nowhere near the levels they were prior to sort of incredibly low interest rates. Do you think that consumer stocks will continue to sell off, that there will be a mass correction within that sector?
I think if they've been described as bond proxies, they've performed very well, not necessarily because they've grown sales or dividends. It's often because they've been like a bond. And while we are quite confident that the bond market has now finally turned, moving back towards some sorts of normality, it is likely that these companies will also underperform as a result of that. And these businesses look very expensive against their growth prospects.
Graham, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.